Alrighty, we are back. And psych, we've got another heavy conversation, money related, finance related. Thankfully, Kyle, just like Megan, just makes it sound like, easy, great. He does a lot of writing and a lot of good stuff for the industry. He's a contributor every now and then for CropLife, and we really do appreciate it, Kyle. Kyle Welborn is the general partner for Cultivation Capital. So, we're just going to roll up our sleeves again and dive into this hard stuff. And thankfully, it's Kyle talking about it and not me. But Kyle, thanks again for being here. We're just going to go down AgTech exit landscape. First kind of topic on our list here. You mentioned IPOs have largely failed, whereas M&A is dominant these days. Tell us a bit about that. What's going on in that space?
Yeah, so as a venture capital firm, we're investing in AgTech startups, and so we're buying shares early and hoping that those shares are worth a lot more money down the road, just like the founders and employees at a lot of these companies. So ultimately the liquidity event when everybody gets paid, ends up being the exit. So we spend a lot of time trying to understand what the landscape of exits look like across ag-focused venture capital. And so over the last decade, there's been 210 exits across ag tech. So that's everything from kind of novel food to digital ag, novel crop inputs, new season genetics. 90% of those were through M&A, and about 10% occurred through an IPO or a SPAC listing that resulted in an IPO. Okay. When we've looked at the IPOs, they've largely underperformed. They list at a price at an initial market cap, and from the IPOs that have happened over the last decade to today, market caps are down over 90%. A couple of them have gone bankrupt. A couple of them were taken private right before they would have been delisted because their share price fell, too far below $1. So the IPOs have not shown themselves to be a realistic exit path. So that really kind of then gets focused on M&A.
Yep.
And so when we've really looked at the M&A landscape, about 33% of those exits, so the M&A exits, there were really a large ag company buying a startup, often for the access to the technology. Right. And then about 67% were sort of startup on startup acquisitions, which are often trying to sort of bulk up and get to a point where they may be more interesting to some of those larger players.
Okay. So the ag market, again, just kind of on the outside looking in and following just kind of the macro trends. So the ag market is still in contraction. What about this cycle? What's the context here so that we can understand what's going on?
Yeah, so people who have been in the agriculture industry a long time often talk about a 7 to 10 year cycle in ag, where there's often a period early on in the cycle of expansion. You often got rising commodity prices, and people are buying more, and therefore ag input companies are building more and ultimately expanding. That often leads to an overexpansion, which leads to a contraction, and then often kind of a recovery. So I think we're definitely in an ag cycle. I think it's fair to say we're still in that contraction phase. We haven't quite got to the recovery to where we saw commodity prices in 21 and 22. And so as that results to M&A, just like we've heard about earlier today, when farmers are looking at new technology, low commodity prices often means that they have to see big ROI fast in order to buy something new. Yeah. And the strategics have a very similar behavioral pattern. They need an acquisition to be accretive pretty much right away. And so that has put a strain on a lot of ag tech startups because you're not yet generally profitable. If you're bringing novel crop protection, you have to go through regulatory, you have to do field trials. It's many, many years of work. We have found across those 210 exits, the average time from the founding to the exit is 9.5 years. So it's almost a full decade of work, before there's the average exit happens. So you have to find a way to finance all of those years, often before there's profitability. So yeah, we're seeing, I think, strong interest when companies have EBITDA, positive EBITDA, and you can roll that into a model where the public company can show that acquisition is going to be accretive fast. That those can be still really powerful and lucrative exits, but where the technology is still losing a lot of money and still kind of in growth phase, it's been a harder and harder sell, on the M&A side.
Mm-hmm. Okay. You also mentioned when we were kind of prepping prior to our sit down today about structural pressures on incumbents. Yeah.
Yeah, I mean,
About that.
when we spend a lot of time trying to understand ag's IP landscape. What major crop inputs are losing patent protection, and so looking back over the last 25 years. We found examples of at least 20 major ag products that have lost patent protection. When we added up the final year sales on those products, it was in excess of $27 billion in 2024 dollars. So that's a lot of revenue to start losing or to start kind of transitioning to the generics market. The hard part, public shareholders value companies with sort of innovative, proprietary IP protected products much higher than they do. They tend to value companies that produce generic off patent products. The ratio's about $2.80. So for every dollar of sales that an innovative kind of patent protected company has to equal $1 of market cap, a generic company needs to sell like $2.80 in total products to get to the same market cap. So, trying to get 3 times as many generic sales versus $1 of a patent protected sales is a big climb. And so we see that as being, I think, one of the drivers for M&A kind of moving forward. Companies that have, patented protected crop protection or crop inputs that can help replenish the falling off the patent cliff that a lot of the large strategics have had over the last few decades is going to be critical. And as an industry, we're also just seeing fewer novel active ingredients make it to market. There's some data that in the 1980s, over the course of that decade, there were 93 new crop protection active ingredients brought to market. In the 2010s, there was only 38. So, we've seen about a 50% drop in the number of new products being brought to market, while this massive $27 billion drop in patents that have already reached their cliff. And so there's definitely a build versus buy. Otherwise, you're really you've got a profitability hole at those big companies that you have to fill.
Yeah. So given all that, for startups, where is the opportunity? Where are the bright spots?
Yeah, so I mean the bright spots, we're seeing companies that we're seeing a couple of things. One is a lot of the large ag companies have a number of programs where they are partnering with early stage companies early in the life cycle. So there can be some joint development contracts, milestone-based payments that we're seeing some companies take advantage of that lower kind of the venture capital investor dollars they may need to raise and bring in some revenue a little earlier for some of those things. And then we're seeing, for the companies that can be really capital efficient and start to get to profitability, they really are in a strong position because there's a lot of folks who are looking to buy profitable assets. So when startups can find a path with a limited amount of invested capital, they can get to profitability. They can really start to design their own outcomes in some ways because the EBITDA multiples start to get pretty exciting for the investors and shareholders of those businesses.
Yeah, great. We have about 30 seconds or so. Just kind of any final thoughts or anything on, my prior guest was mentioning the interest rates and, like I said, the macro things. I don't know how much, trade policy, geopolitical events, other risks out there, and anything that just we should bear in mind as well as we.
Well, I think the ag cycle doesn't stay in contraction forever. So there is going to be a point where we start to reach recovery and start growing again. And yeah, we think for entrepreneurs, folks with really novel technologies that often have patent protection that are at some level of profitability, we think they're going to be really well positioned as a lot of the major ag input companies come to the market to start buying new technologies to overcome some of these patent cliff challenges. So I think the future should hold some good outcomes for a lot of companies.
That's awesome. Thank you, Kyle.
Thanks.
I appreciate it.